Luvuyo gave his life to work beneath the ground. Years of hard work, sacrifice, all for a future he hoped would be easier. When the work was done, he went back home with only what he thought he had. But what he didn't know is that something was left behind, a benefit with his name on it. Until one day, a call came through. ICTS tracing services had found him and found what was his. Because what you're owed should never be forgotten. Now Luvuyo's dignity is restored. His story complete. ICTS tracing services, the benefit you never knew about.
Ladies and gentlemen, welcome to this episode of Exec Meet and Greet here on EBnet. Today I'm delighted to be joined by someone all the way from Dubai who's going to be talking to us about private equity investing and a career in private equity investing. Our guest for today is Nabeel Laher, who is the managing partner, international private equity at Old Mutual Alternative Investments. Nabeel, welcome and thanks so much for joining us.
Yeah, thank you, Leon. Looking forward to this.
How are things in Dubai? We always hear these stories of people left cars on the side of the road and all the rest. Are you re-stimulating the economy?
I'd like to think so, Leon. But it's obviously been a difficult period just generally in the Middle East over the last few months with what's been going on more politically and geopolitically. But on the whole, it's really stable. Life has continued as normal. So it's been a fantastic place to be. Dubai and the UAE and generally the Middle East has been on a growth trajectory over the last decade, and it's attracted really high quality people. So the investment industry, in particular, across the UAE has really burgeoned and grown into something that looks very sophisticated today across the private equity and hedge fund ecosystem.
And having a serious war on your doorstep, has that affected you guys at all in terms of day-to-day living, or was it a bit of a shock and then everyone moved on?
I think for around 6 weeks or so, there's lots of hesitation and uncertainty in the air, and a lot of folks who could get out got back to their home countries just to feel a bit safer. I don't think anyone felt there was an issue around personal safety, just given how well managed the Dubai government and the UAE government managed things. So they've been incredibly prepared for this. And I think that surprised a lot of people. So no, I don't think there was much personal safety concerns. But look, no one likes to be in an environment where, there's lots of uncertainty and their kids are, living day to day in somewhat an unnormal situation. But look, I think it's so far so good. You come to Dubai today, you won't even know that anything happened. Life has continued as normal. I'm pleased to report.
So Nabeel, you're based in Dubai. You're South African born and bred.
South African born and bred. Spent my whole life in South Africa. Grew up in Johannesburg. So definitely my blood's all South African. But I think it's important to expand your horizons and expose yourself to different people, different cultures, different ways of doing business. And especially in our business, being that we're internationally focused, I think it's a bit more tricky to do it out of South Africa. So yes, Johannesburg and South African heritage.
So let's maybe take one step back. I want to come back to how you got into this position where you are right now, but I want to just take a step back. I mean, when kids are choosing careers or starting to choose how to specialize their subjects in school, at school or going to university, not many know about private equity investing. They might know about investment management as a topic, but when it starts breaking down between private equity and different types of private equity investing and how that's different, they don't know much in that regard. Now maybe that's okay, because maybe the fundamental studies are the same and then you specialize in some way. So can you maybe just spend a minute to explain to the audience, what is private equity investing? What is your job all about? And when you do that, why do you have to be in Dubai? Because I keep on having this debate about, can you manage assets globally when sitting in South Africa. Now, maybe you can if it's listed, but maybe it's more difficult if it's not. And just give a feel for that, because it starts talking to the global nature of certain jobs and so on as well.
Yeah. The first thing I'd kind of just contest a little bit, I think in South Africa, we've had obviously this history where a lot of folks who went into the financial services industry and ecosystem were financially trained. So, most typically the chartered accountant route. That was a typical kind of route most folks followed. But if you look globally, that is absolutely not the case. So you look at the top kind of investment management folks who are sitting out at the big centers, whether it be London or New York, etc. A lot of them they study philosophy at university or engineering, or some of them even medical doctors today who are now pivoted into a financial career. So I think this notion that you've got to study finance to be in finance, I think it's actually a myth. It's a bit of a South African phenomenon. And I think you want actually variety in the backgrounds of the individuals running capital, because diversity is actually what makes great teams. Right? So I would say, I think my message to younger people out there is that you got to try to meet your passion. What is your passion? And go down that route. Really, to be successful in this business, you got to be in the top 1%. Right? And you're not going to be doing that if you're not truly passionate about what you're doing. So, I think that's kind of the bedrock of it all, is that don't think you need to do finance or become a chartered accountant or to be successful in the investment industry.
So what I'm hearing from you then is you also don't need to specifically have private equity investing as a top of mind career path earlier on in life. You can effectively pivot in that direction regardless of what you're doing. I was actually having a discussion with a teacher at my kid's school last week when my daughter's making her subject choices, and they were talking about art and trying to encourage my daughter to art. And I'm the typical, I don't know what I am, a millennial or baby boomer or whatever. And I was like, art doesn't help you with anything. Okay. And they were a bit taken aback and said, no, but it helps you in terms of reasoning and structure and all of these kind of things. And it's also now measured when it comes down to your university exemption and stuff like that. So I was like, okay, I just had a bias essentially. So you chose a route of doing almost more the traditional financial side. What was your thinking at the time? Was it the usual, okay, accountant, doctor, engineer, and then it evolved from that?
Look, I come from a family, Leon, of business people. People who started their own business, very entrepreneurial in nature. They didn't go to traditional corporate career. They were all very successful, actually, but they just took a different route. So I grew up in an environment, in a home where, I was always thinking about, about business, talking about business on the dinner table. So I always wanted to be close and tangential to that, to be in business, right? I think that's where the love of business, that's what private equity really is. It's buying private businesses and making them better. In a very simple sentence. People get caught up in all this terminology, etc., but it's really buying a real business and seeing if you can pivot and grow that business and take it to the next level. So my love for business started at a very early age. And, I picked up this quote somewhere along the line. I can't remember exactly when, Leon, but it was about Warren Buffett said, look, accounting is a language of business, and got me curious around the profession. Obviously, it was very topical. You look at the JSE list and half the directors are chartered accountants. And I kind of, whether rightly or wrongly, made this connection between being a CA, being in business, and creating a potential opportunity for me down the road. I didn't know that I was going to end up in this career, but I did want to be close and tangential to the business world. And I felt that the profession would always give me that underpinning, whether I do something on my own, whether I join the family business, or whether I go into a professional corporate career.
You made me feel comfortable, because my words to my daughter last week was, well, first of all, she gets A+ in accounting, but she doesn't really enjoy it. She's like, it's just easy for her. I said, no, you have to do that, because if you're going to be successful in any career, okay, and you're going to rise through the ranks, at some point in time, you're going to encounter an income statement, a cash flow statement, a balance sheet, and you're going to have to be able to interpret and understand and talk around it. at the end of the day. You've got to be able to count the numbers. That's the reality. So luckily she chose accounting. So I can feel proud about that. But I mean, like, let's talk then. You went down that route and then you did a CFA, and CFA has become a prestigious degree or qualification to have, and that starts leading you in the direction of specializing investment wise, but still quite broad. I mean, you could go private markets, public markets, still both are covered.
Yeah, look, I think the CFA it's a very rigorous course. I would argue possibly maybe something controversial. I think it's even more rigorous than becoming a CA in terms of the content and the difficulty of the content. But I think what it really does, it sharpens your mind and gives you the foundational basis becomes so strong around anything around finance. So it gives you the language for you to communicate in the finance industry. So look, I think today, just with the advent of technology, with AI, etc., you don't necessarily need to go to a CFA to gain those components in terms of the base knowledge. I think you can get it from doing it online yourself, to be honest. I think if you're a self-starter, you could do most of it. And I think the real message is don't get caught up in, I need to do the CFA, I need to do the CA to get into the industry. I think you have different paths and different routes, but I think whatever you do, you got to be at the top of the pile, right? So if you're going to be an engineer or you're going to be in a medical student, you want to be in the top few percent. That's going to create multiple opportunities for you because people hire intellectual ability and capability. Right? No one expects someone to come into the private equity industry and know everything. But they want to know that you've got the horsepower, the processing ability to be able to become successful in this career, right? Would I hire the average chartered accountant versus the top 1% of engineering students? I'd hire the top 1% of engineering students because that individual is going to give me much more horsepower down the line when I require it. People can learn stuff. Human beings are an amazing subset of the world's habitats. And they just have an incredible ability to learn. But you need to be able to have the raw materials to be able to put that into something that's successful.
Yeah, so you're saying that your choices will always be there regardless of studies, but even though that there's more specialized degrees now, like the CAIA or whatever the alternative investments is, at the end of the day, you're saying it's there, it's fine, but it's not going to change your dreams.
It's not. And if I look at globally again, that's my reference point, Leon, if you really want to have an international, global, relevant career, the amount of chartered accountants or CFA chart holders sitting in United States private equity is probably a few percent.
Yeah.
The rest of them have completely different backgrounds. And I think what's happening in private equity, there's been a bit of a change in the industry over the last 20 years, is that initially it was mostly bankers who got into the industry. You went in traditional, I was at JP Morgan, I was at Morgan Stanley, I did a few years of banking, and then I pivoted into private equity. Today, you'd find a whole host of operating folks in those businesses, in private equity firms, who are actually assisting to run a real business. How are we going to grow top line? What are we going to do about the manufacturing plant in Oregon? What's going to happen with our supply chain? Being a CA or a CFA doesn't help you, think through those things. I think so. It's a combination. There's a place for different people in the ecosystem today. Financial skills are important, but just as important is having other skills to complement it. So I think you can pivot and you can fit different roles within the private equity and business ecosystem.
I actually think private equity is quite, I'm trying to think what the right word is. I think it's intriguing, but what I feel is that in the public market space, as an portfolio manager, you're quite removed almost from the people. It's very analytical in nature. It's about valuations. Yes, you interact perhaps by doing a bit of management research and trying to understand their customer base, the demand and so on. But you're never sitting around the same table or taking the same responsibility. Where with private equity, effectively, your job is to run multiple businesses, buy and sell multiple businesses in multiple industries at multiple different stages over time, where the fantastic nature of it is that you get to work with management. Okay. I'm putting that on the table because I want to test you on a couple of things. You get that opportunity. So you also need to be a bit savvy up here in terms of your EQ of how you do that, because you can be a massive threat in that regard. And let's face it, when I was in corporate and we, for the first time, had a private equity partner, all of us in management were like, yeah, what's coming? Okay, are we going to be just shifted immediately? Because that does sometimes tend to be the perception. So facilitating that's the intriguing part, is that you've got to go beyond just the numbers to work with the people to get results. And at the same time, you're also making a judgment. Are these the right people to get us the results over time? So there's a fine line. And how do you, when you're in that situation and now you're so aligned around the table, also divorce yourself from the emotion of the decisions, because at some point in time you have to exit. You're not going to be there forever.
That's good. Look, I think you bring up one of the most topical questions in modern finance today. And I mean, we talk about this, in financial language, principal agent risk. And you're seeing it playing out massively in the public markets, right? So the distance between the providers of capital and those folks running the business is massive, right? And that's why you see a lot of decisions being made in public market companies that are not in the best interest of shareholders. They're in the best interest of the management teams running those businesses. So the principal agent risk is really big, because those providing capital and those managing the businesses are not aligned in terms of their incentives, not aligned enough. And Charlie Munger, the famous investor who recently passed, he had this line, is that show me the incentive and I'll show you the outcome. Right? But I think where private equity is a superior governance model is that the agent principal risk is less than what you'd find in the public markets, because the private equity practitioner and investor is very aligned and very close to the management team of the company that they've invested in. Either they brought in that management team, so naturally that would be a closer alignment. So ideologically, they are aligned in terms of where they want to take the business, and then also aligned around financial incentives. So we aligned, we want to exit in 5 years. If we get you and we hit a certain return, this is how much you're going to make. This is how much we're going to make. It's very clear and documented up front. So that alignment, creates the magic, because everyone's pulling in the same direction. And that's really the power of the model. Because often the difference between the execution is the human capital, right? The human capital is really what creates a winning investment or losing investment. You can have two very similar businesses, but ultimately it's about execution and getting the right people on the bus to execute on the vision and the strategy. So, and that's where, there's a departure from the accounting mindset, which is a lot backward looking. But investing is actually a lot about forward looking. Yes, you've got to analyze where you are today, and I think finance and accounting gives you that. But what's going to take you to a really good outcome is the future, and that's where you have to get your alignment with management teams and the vision right.
So to help everyone understand, the public markets, you would buy and sell shares on a listed exchange. You would do some management research, company research. You would build your models. You would choose what you want to buy. You would have an expectation of where the share price is going to go, and then you would probably sell at some point in time if you have the discipline to do so, and you would move on essentially in the process and hope your returns are looking good, and that's how you generate business. In your space, you're looking for businesses, some good, some bad, where there is the potential to create good in the future, but you have to unpack that jointly with the people either that are in place or others that you bring to the table to do that. So you're hands on to a degree in terms of that facilitation. You are in effect running a business, albeit from a little bit away from the day to day, if I could put it that way. So is that a decent description before I talk about term and so on?
Yeah, I think that's a decent description. So in fact, in private equity, a lot of private equity opportunities that you want the business to be underperforming, because you could probably enter at a certain valuation and purchase price, and there's low-hanging fruit in terms of getting the business right size. So it could be along a multitude of factors, not getting into the weeds too much here, but it could be the fact that actually I've had a very weak CEO for the last 10 years on this business. It could be the fact that they've got 3 salespeople where the market standard is that they should have 20. It could be that the ERP system is not right size for the AI challenge and the AI opportunity, you know. So you want actually an undermanaged business, but the core of the business, in terms of its value proposition, needs to be very strong. And that really creates a really great private equity transformational opportunity. Taking something at its core that's really strong, but then transforming it into something different, and then getting paid for that when you want to exit the business.
So the reality is often people tend to think, okay, private equity is smaller companies. Okay, it's helping them grow, which is a total fallacy, because it can be anything from a new idea that's up and running and generating a bit of income but needs to scale, all the way through to a mature business where it's ticking along, but perhaps it's carrying a whole lot of unnecessary costs, and by having the management buy it out and get them refocused and, you know, energize it, you can get onto a new growth path kind of thing. So it ranges completely, and I want to say the market's bigger on the private side than what there is on the public side in terms of choice. I always see investing in private markets as a massive diversification opportunity, because the scope of what's out there is so significant. So is that correct? Is it a case of there's a broad scope across industry as well as across size and or maturity of business?
Yeah, you're getting uncorrelated exposure to what you find in the public markets. So it's businesses that don't look like in verticals that don't actually exist on the public exchanges today. And we've seen this trend. I don't know if you've seen this trend, Leon, but over 20 years, there's only about a third of what public companies were 20 years ago. So there's been a rapid, kind of actually quite a massive contagion in public markets has shifted onto private markets. But coming back to your early point around this myth around private markets really for businesses, can just break it down for the viewers in simple terms. If you think about, there's really three buckets that we're looking at here. The one is, and it all fits under this private equity banner. The one is venture capital. So venture capital is what kind of you alluded to, is idea generation. It's starting something from scratch or very early stage. It's kind of, everyone reads about it in the press around, what Facebook was, etc. So venture capital is starting with a very kind of early idea generation and trying to build it into something that's very game changing. And a lot of them think about, how can we change the world? That's kind of the common question they ask themselves. So that's a piece of it. Very high risk investing there. The loss ratios are well over 50% in that part of the marketplace. It's what we call a power law game. So it's the one or two companies driving the majority of the returns in the outcome.
But those one or two you're hoping are unicorns that are going to do exceptionally well to cover the losses, essentially.
Essentially, that's exactly it. And the second bucket is what we call growth investing. And the typical definition of a growth investment is that the company is at the inflection point of profitability. So it's got a good product, it's proven market fit. So we call it product market fit. It's very good. And it's ramping up the sales nicely now, and it's almost going to be profitable. It needs more capital for growth, right? So it's money into the company, onto the balance sheet to grow the business. And the third leg is where we mostly play, is cash generating businesses that are profitable, that are most likely undermanaged or have the next phase of growth. So maybe they're quite well managed, but they want to go into a new geography, or they want to go into a new product line, or they want to do a transformative acquisition, or they're just undermanaged and they need to be managed correctly, or they haven't optimized their balance sheet or their capital structure. So that's kind of the area we play in. It's probably the lowest risk of the three in terms of probability of outcome, but it's got a different kind of risk around execution.
Okay. So you mentioned the fact that private markets has become so much more popular. It's almost like the listing boom of the 90s was everyone. I keep on thinking of that Peter Stuyvesant ad where guys were skiing through the snow and drinking and smoking and carrying on. It was just a sexy thing. It was like the listings of the time. Everyone was, up in the lights. That has changed for whatever reason. And my take on it is that I think there's something about the average tenure of a CEO in the US is 6 months or 12 months or something stupid like that. So the pressures have become so high on listed companies for short-term earnings that it's almost become impossible It's like being a football manager on the Premier League. I mean, unless you start winning from day one, you're going to get fired. Some get fired 2 weeks later. I mean, it's crazy. How do you get anything done in that time? So I think that's part of that contagion. Plus, there's been so much compliance and whatever else coming to the table. Guys are seeing the red tape; it slows them down. They don't want that. But I don't want to comment on that. But from learning from that, even in the private equity space, often we talk about a 5-year term, and I think, geez, isn't that too little? I mean, how much time? Sometimes businesses need, 15, 20, 25 years to truly appreciate and get the value. We're trying to squeeze it into 5 to get a certain level of return. Could that not actually hinder the longer term in some way?
So, I mean, most underwriting, so, when you're looking at investment and you're thinking about how this investment is going to pan out, when I'm going to exit it, most of it is done on a 5-year basis. I'd say that's the average. What we're finding today in the private equity market is that most investments are taking longer than that to exit. So that's been pushed out. That's the first point. The second point is that there's been other vehicles that have been tested in the market to drive this duration of capital, right? And so if you really think about it, most investing is about picking the winners. I mean, even in the buyout space, that the more mature businesses, you'd have some very good, reasonable returns, but there's a handful of companies that generally drive your outcome in a particular fund or portfolio, etc., right? And how do you compound capital? Because the whole game here is about compounding. Never interrupt the process of compounding. It's one of the most powerful things in finance. And so what a lot of folks have done is they've created different structures where those assets can live with the manager for a long period of time, but still kind of satisfy the original agreement you had with the investors that backed you in the first time you originated the asset, and give them money back before you continue the journey of that particular asset. So there's different ways there's something called continuation funds, where the asset is moved into a new vehicle for another 5-year period. We've got what we call evergreen structures now, where they're long dated, pretty much forever vehicles, where you can hold the assets for a long period of time. So there are different models that are testing, the old existing model. But I'd say it's still a very small percentage and part of the industry today. But I do agree with you; it's a challenge of the industry, and that's one of the probably the cons of the private equity model, that it doesn't possibly allow you to compound capital like you could in the public markets.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
So it's an interesting concept that, and I'll come back to the psychology then. But before I talk about that, I'll just another point. In private equity, you could be investing in a pharmaceutical company, or it could be in something that's arms related, or education, or entertainment, whatever it might be. It's cross sectors. How do you? My brother's an engineer, aeronautical engineer, and he'll sit and talk about the business that he's responsible for, and I stare at him as though, okay. And then I talk about mine, and he stares at me, and eventually we settle on wine, and we're happy, right? So how do you put yourself in a position where you're able to be competent, to be able to analyze all different businesses of different kinds?
One of the most important things in life that I learned early on is that find the right partner, right? And that goes probably from your spouse to your business partners. Spend a lot of time making sure it's the right partner, because your partner risk is really where it blows up, right? So if you think about the way we're investing, and it comes back to your question around, can you do this from afar? Can you build a global portfolio from the southern tip of Africa? We've proven it's possible. And that's because we've actually backed the right partners, and we spend a lot of time making sure that we get that piece right. You don't always get it right, but you want to get it right more than you get it wrong. So we are not specialists in every single field. I can't be a specialist in, like you said, a pharmaceutical deal or a TMT deal or a software deal. The nuances of those industries and sub-verticals you need to spend a whole career. You need to spend 40 or 50 years in the space really to understand it, right? So you want to be partnering up with folks who are living this day to day, right? And you bring something different you more than capital, but you different kind of partnership mindset to the table. But it's the partner that's bringing those nuances. I will, however, say that with technology today and with AI, it's shortened the duration of getting up to speed in spaces, right? If you want to get up to speed of what's happening in a certain part of the pharmaceutical industry in the United States, before you need a McKinsey report, you'd have to pay a lot of consultants. I'd argue in a couple of hours, I get to like 60 or 70% of where I need to be in terms of just understanding the dynamics of what's at play.
Yeah, I think it's funny you say that. I actually put together an ESG paper earlier this week where I was having a debate with a colleague around gender equality. To me, it's a misunderstood stat that everyone jumps on the bandwagon about, and it needs to be unpacked and understood better. So I wasn't winning the argument, so I was just having high-level numbers thrown back at me. So I said, fine. And then Grok and I got together one night, and I put together a paper with all of the stats around gender equality. And it took me, I don't know, probably an hour. But it was an hour of thought and an hour of asking a range of questions and an hour of learning for me, which was quite an experience to ultimately go through. So I can understand how the world is narrowing in that sense. But surely, as a private equity manager, it must be stimulating being able to, analyze these different businesses or get to understand them, even not, maybe it's not to 100%, but even at 50%, just to get to know so much out there around how the world works and the different aspects of what's the right word, of economies.
Yeah. Leon, if you're not a curious individual, stay away from this industry. Right? I think that's actually more than, we spoke a bit about professions and what you study. But actually, I think one of the most important qualities to have to be a really good investor is to be very, very, very curious. Because curiosity is really what drives the passion, turning every single rock, what's underneath it. And I think that comes back to your question around, this has been one of the most rewarding places for me to spend the last 12 odd years. Is because I get to meet super interesting people globally at the top of their game. They're the top 1% in their spaces. And I get to learn from them every single day. We get to learn about different industries and spaces. And then, we talk about compounding, but not your capital doesn't only compound. Your knowledge, your insight also compounds. So take out in the healthcare space. When we started out doing healthcare in the US, we didn't know anything. But today, we've got a very nuanced understanding of the healthcare ecosystem in the US. And we can speak about different parts, different articles, and different parts of the act. But that knowledge is compounded over a long period of time, right? So, yes, I think curiosity is super important. And it's the most rewarding industry because of the people. And then you're always learning, and the world keeps on changing. So you're always challenged around where to pivot to, what's going to be the next wave of growth, et cetera, et cetera. So yeah, you're right. I think it's truly it's a gift.
So I see it as one of the most attractive things of being in the private market space is that broad range of exposure that you have, to a degree that it's more than just face what's the right word, it's skin deep kind of thing, which I think is fantastic. But now I want to ask the difficult question, because this one I struggle with. All right. When you're involved with a company, you're invested in it. You're in, all right. You've made your decision, so you're already accountable to a certain degree. Exit has to be difficult. So obviously, exit when you've been successful is probably easier than exit when you haven't been successful. Okay, because you want to make it work out. So it's your own personal accountability. But even exit when you have been successful and you've been high-fiving and having the odd party with the team and congratulations and we've all worked together, it's got to be damn difficult to do, because we're all human and you form bonds through that process. So maybe share that a little bit with us. Or how does that work without making yourself seem as though you have no empathy at all, kind of thing? Yeah. How does that work for you?
It comes back to the very transparent conversations up front, right? And I think that's where real true partnerships are really, and solid partnerships of trust and credibility are built. It's all up front. So I think, and then, people do what they say they're going to do. at the end of the day, right? I think that trust and credibility just grows. So I think it's getting that alignment up front. That listen, here, this is a marriage for 5-6 years, and there's alignment. But I think today where we are, I think your question a little while ago would have been even more important. But today the management teams are so wide into what the private equity model that they buy. You don't go close to private equity if you haven't bought into the model. In the US, the folks know, like, I'm partnering up with private equity. In 6 years, we're going to make
so
a
everyone's aligned in terms of that end goal. Yeah,
the alignment happens, and you think about the exit up front. You're really thinking about, okay, who are we going to take this asset to? Are we preparing for a strategic? Or are we going to sell to Blackstone? Whatever it is. Obviously, there's no certainty in life, but you really think through what are you going to be selling it to who, and why the value proposition to that buyer would be so powerful.
Okay, so ESG has become a topic, and it's been bandied about, and some people see it as a swear word and a waste of time. Others see it as central to everything we're doing. I'm not certain exactly when we'll publish this interview, but the PRI, along with the FSCA, released a report this week on responsible investing that we've been covering, where the average asset owner has a policy but is not really doing much about it at the end of the day. Part of why pension funds aren't really supporting private markets, because if you have a development sort of mandate, you would tend to go where you can maximize the opportunity. But ESG is a set of principles that ultimately can help you in making decisions. I won't go into more detail than that. How do you view ESG in the space of private equity? Because since I've been involved with private equity, going back to COVID sort of times, ESG was always on the table before it was spoken about from the public market perspective. So why is that also the case in your mind?
Yeah, it's a very controversial topic, by the way, because there's a subset of the financial community who actually think it's all a bit of nonsense. Right? There's a subset of the community that takes it extremely seriously, and then there's a subset of the industry who think it's important but actually don't know how to measure it. What does it mean? It means different things to different people. So, and then imagine trying to do that under global context, with all different geographies, cultures, etc. So, and maybe I'm going to simplify this quite a bit here, but ultimately it's about doing good business, and being a responsible investor. And as an investor, are you moving the world forward or are you moving it backwards, right? And that's kind of the first principles thing to think about. But I would say there's a lot of bifurcation globally. So if you today in the United States, it doesn't really come up in conversations, right? Europe, you'd find a lot more conversations around ESG compared to the US. So there's a completely different mindset out there. The US folks don't even put it in their presentations. It just kind of gloss over it completely. So I think it's an interesting thing. I just think there's too many different standards out there. There's too much confusion around what standardization looks like. For example, if you're sitting on the West Coast of the United States, hiring an Asian individual who's female could be a very positive thing to do, but in a different part of the world, what does that mean? It means nothing, So yeah, it's an interesting question, but I think to me, it's about just being a responsible investor and make sure that you're moving your staff forward, moving the environment forward, and what you can do in the compass and realm and sphere of a particular investment opportunity.
So the way that I also see it is anything too rigid or absolute in its nature is difficult or dangerous, if I could put it that way. To me, ESG, there's a range of principles that are there that you should look at and pick from to say, well, this can help, that can help or not, or whatever it might be. And it's no different, and this is where I'm going with the questioning, to a simple belief system. All right. You as you've been talking, I can immediately go write down a couple of beliefs that I've picked up in you. All right, based on what you're saying. And these are things that you've learned from through your experiences, through your studies, through your upbringing, through your perhaps religion, whatever it might be. All right, you formed that. And it's the same in any career at the end of the day. ESG is actually a way of supplementing that, but also trying to close the gap between parties who might have differences in that, so we can understand each other in terms of it. So we look for this, we look for that, and then you can go, because it's quite easy. I can come and sell you anything. Okay, this is the best mug in the world. Okay, but it's this, but inside might be empty. All right. So it's what do you ask to make sure you get something inside of it? All right. So that's where I think ESG helps, is as a tool to help communicate, understand. But I agree with you, it's difficult. How do you measure different types of measures, different parts of the world? It becomes confusing. But it shouldn't be about that. It should be about what do we believe in? And making sure that that conversation happens, because the conversation tends to be just about the financial outcome. We're targeting CPI plus 10. Okay. But how are you going to get there? What makes us get there? Okay, so if I want to close today talking about what I believe is the most important thing, which is what are the beliefs, and you've mentioned compounding, okay, as one of those. What are the beliefs that you've built up over time that stand you or make you an excellent private equity manager, which clearly you are, because you hold a senior position, you're globally focused in terms of things. So you have to have a quality skill set, essentially. So what are the beliefs that you built up beyond the studies that hold you in good stead?
Cool. No, I think it's one of the cornerstone questions every investor should ask themselves, because to be a really good investor, you really got to understand what kind of investor you are, right? And if you don't understand what kind of investor you are, you're more prone to being attracted by the fad and the mania and this new hot fund that's come out here, and I see a headline around cryptocurrency and I want to go put some capital there, etc. So I'm not making a determination on any of those asset classes, but what I am saying is that really understand what kind of investor you are. And I'm talking already around investment philosophy. So people confuse the philosophy question and the strategy question. Strategy is the execution of a philosophy, the execution of a belief system in how you want to be an investor, and what do you think are the core tenets that are required to be a good investor. And I think most people, to your point, pick up their personal philosophies through the environment that they operate in, through their upbringing, through maybe religious understanding or practices. Their beliefs start emanating. So if I think about my experience growing up in South Africa, which is actually very interesting in my generation. To grow up in South Africa was a very interesting time and one of a huge opportunity, actually. And then how did I get into this space, etc. And then also my upbringing, right? So what were my parents like? What was my home environment like, etc. Sorry, it's a bit of a long-winded way to your question.
Oh, no, it's good. This is important stuff. Yeah.
It's important just to understand the bedrock of it all. So I think these things come from different places. And I think they really form how you make decisions and process them, in what kind of framework you process things in. So if I go back a little bit, if I can take you back a little bit into my experience, is that if I look at, I think your relationship with money starts from a very early age. So you think about, take your parents, for example. If I look at my father, he obviously grew up in South Africa. In a way, he broke the mold a little bit, because he got my brother and I into a, kind of an old established boys' school in Johannesburg. And given the political situation in the country at the time, we weren't actually allowed to be there. But the school took a chance on us. They took a bit of risk on the situation. And to understand him a little bit, he went to Waterford in Swaziland, which is a boarding school in Swaziland. And he was alongside like the children of Nelson Mandela, Desmond Tutu. So he came back from that experience that education is a pivotal thing for his kids. And the reason why I say this is because, in a way, he took a bet, right? He took an asymmetric bet. He had limited downside in trying to get us into this old established boys school where we were not supposed to be. But the upside was life-changing. So I look at a lot of things in my life around asymmetry, and that comes into my investment world as well. When I look at an opportunity, I think around what's the downside here? What is the probability of downside? And what probability do I have with the upside? And most of our investment opportunities that we make in our space today, we believe have an angle of asymmetry, right? So there is a probability of serious outperformance, but we want to protect the downside. If I go into to my mum, I mean, she was kind of taught us the value of things in life and never to waste. And I think that being like a value investor, I consider myself a value investor, started at home, because those disciplines is where you start thinking around like margin of safety, thinking like you don't want to lose, you want to always have a buffer, you don't want to be wasting. And that kind of informs the way I invest today around just, if I think the valuation of a business is 100, I want it to be trying to getting it 80. And that's kind of the thinking that she installed in me. And, my wife, which is my spouse, I think she taught me about the possibility of the upside, right? Because thinking about the downside is one thing, but to make money and have alpha, you got to think about the upside. What's the possible? And she would always challenge me around what's the possible. So I think she was an influential piece in that. And maybe the last leg of this, Leon, is around my grandfathers. They started their own businesses. They weren't as qualified as people are today. And you wouldn't find it on typical CVs today, but two real things that stand out in terms of their behavior. They thought about things literally in decades. So made me think about our business in a really long, multi-decade way. And they thought about relationships as a competitive advantage, right? But not in a transactional way. They were sincerely interested in other people, in helping them grow and get better. And the advantage was a byproduct of the process. It wasn't the reason that they built these relationships, right? So I think that's allowed the partnership mindset that I spoke about earlier to really be very important to me as we built out this business here as well. So it's thinking around downside, asymmetry, what the art of the possible is, and then really partnering up with the right people. And that's a lot of the core philosophy that we've adopted in our business. And that really comes from my childhood and all my experiences coming right through here. I've simplified it a little bit. There's a lot more there. But I think that's kind of the essence of it.
I must say I find it fascinating, and also it helps me reflect a little bit. And I think to myself now, the role that your parents, even your grandparents, played in your life without you even realizing it at the time is so significant. It's probably more significant than any of the studies that you've done or even what you've learned in your career, because it's been the bedrock of who you are and how you go about doing things. It is your belief system. It's your ESG that you apply, the filter that you apply to everything that you do. And as parents, we have an awesome responsibility. And we don't even sometimes realize what we are instilling within our kids. But that I think it's a brilliant answer, and I thank you for sharing that, because I do see value in ESG, okay, but I see it in value in being used appropriately. Okay, so I see it as a way of unpacking all of the different things you can think about, and then you apply it through your research or through your decisions or whatever it might be, which is effectively what you're doing. It's inbred within you based on your past. But anyway,
maybe the last thing, Leon, maybe you haven't asked the question, but to younger people out there, because I've got a 14-year-old son, and I think about what kind of lessons should I be imparting on him to create the opportunity for him to be successful, right? Mm-hmm. And I was thinking about this just before this podcast, and I thought, look, this curiosity point has been well made by myself earlier in the podcast. So I think that goes without saying. That's like a qualifier. But there's probably three things I think about the young people today. I think the first thing I'd say is that build yourself, run your own scorecard, right? Don't run somebody else's scorecard. And I think it's even more topical today in the world of social media, where everyone is constantly comparing themselves to everyone else. Run your own scorecard, focus on compounding your own talents, your judgment, your knowledge, your reputation. So that's the first thing, build your inner scorecard. The second thing I'd say is take intelligent risk. And maybe that we're not doing enough of that in South Africa. There's no certainty in life, but sitting around waiting for things to happen, it generally doesn't happen. So take asymmetric bets on yourself, where things are likely to happen on the upside, but your downside is limited. So take intelligent risk early in life. And the third thing which I didn't really appreciate, till later in life, is that invest heavily in relationships and do it early and be intentional about it. Because it's the one asset that compounds for the longest period of time, and you can start it very early. And I think, that really, it's not transactional. Don't do it in a transactional way. Do it in a sincere, interested way. And I think those things will compound for you. You just never know where it takes you. It could be 20 years down the line where that relationship, bears fruit for yourself. So I think those few things I would leave with younger people just to think about.
Nabeel, that is the eureka moment. I've realized it later in my career. When I was early parts of my career, so focused on success and the next promotion and the next bonus and the next this and that and the whole lot, that you actually forget that you do sort of leave people behind because you're so much in a rush to go there. And what I've learned later in life, and maybe it's just with humility, is that taking the moment just to speak to a person and get to know them. There's so many benefits. You talk about you never know down the line, but even just in terms of the day-to-day getting things done, people talk about how difficult execution is. Well, execution is a lot easier when people are aligned and feel comfortable with each other. So it's simple things like that sometimes we miss within it. But anyway, so that I couldn't agree more in terms of that. You're talking about your son, and it was making me now think. I got my son an Easy Equities account, and he bought some 91 stock, and the stock was down, and I did a webinar, and I interviewed Hendrik de Tooy, and I've known Hendrik back now to the 90s kind of thing, and I said to him, my son's a bit upset because his stock's not going up, and so Hendrik was telling him, sorry, but it'll be okay, and I said, well, don't worry, because my son said this to me. Okay, he said, Dad, in order to get rich, you must go slow. I don't know where he got that, okay, but I thought that's quite sage advice from him. I think he was 15 at the time.
Man. Yeah.
Anyway, so you sitting in a situation, coming back to where we started, it's a crazy world, okay, and you making investments all around the world, and depending on whether it's the Democrats or the Republicans or whatever, you're going to face a different, mindset in different parts around the world. How do you deal with all of that? How do you deal with all this noise, but stick to your knitting and keep focused on the end objective?
Yeah. So look, I think, uncertainty has always been with us, right? At the moment, it's a different kind of uncertainty. But if you go back 100, 200 years, there's always been uncertainty, whether it be world wars, whether more recently COVID, financial crisis. These things will always happen, and there's going to be more uncertainty down the line, right? There's going to be a new man or lady in the White House. South Africa will get a new president in a couple of years. We're going to have another coup somewhere else in the world. So these things, in a way, are given. Uncertainty is a nature of life, and it's going to happen. So I think the one thing that you want to think about when you're an investor, you want to think in probabilities, right? And I think and build this margin of safety thinking into everything you do, right? Even when you I've got a dentist appointment, you don't want to leave last minute. You want to build a margin of safety so you can get there in time, etc. It's like a simple example. So think in probabilities, because the world is an uncertain place, and always have a margin of safety, right? And that's just being realistic about the world and the way it operates. And then give yourself long enough in the game to compound, right? So Howard Marks, who's a very, very astute investor, he says you can't predict, but you can prepare, and that's really what I'm saying, right? Is that think in probabilities, think about a margin of safety, partner with the right people, etc. And the other thing is around alignment, right? So we spoke about alignment earlier. Make sure your alignment is the principal agent problem is mitigated to as much as possible, because that's going to save you when you need to make very tough decisions as an organization, when there's a crisis, etc. So only partner with people where you're structurally aligned. So yeah, I think it's some of those things. It's around having those permanent North Star things and being truly aligned with your investors, with all your partners, and in investing when the probabilities are in your favor, and that way you think, even if things don't go right, we're going to be okay.
Well, that's more sage advice to end off this interview on. So, Nabeel, First of all, congrats on what you've achieved, and the very best to you in the years still to come, to you and your family, and to Old Mutual Alternative Investments. Thank you for sharing you with us, and also thank you for trusting in me in terms of letting the conversation go where it took us. It's always fascinating just to talk and to share in that respect. So a big thank you to you, and very best for the future.
Yeah, and I really appreciate you giving me the opportunity and the platform, and yeah, really enjoy the conversation. Hopefully the viewers or listeners and viewers get one or two interesting points out of it.
Without a doubt, definitely will. Thank you. All the best. Keep well.
Have a good one. Ciao.
Bye.
Luvuyo gave his life to work beneath the ground. Years of hard work, sacrifice, all for a future he hoped would be easier. When the work was done, he went back home with only what he thought he had. But what he didn't know is that something was left behind, a benefit with his name on it. Until one day, a call came through. ICTS Tracing Services had found him and found what was his. Because what you're owed should never be forgotten. Now Luvuyo's dignity is restored. His story complete. ICTS Tracing Services, the benefit you never knew about.